Good morning and Assalamu alaikum and welcome to our Sharia presentation of Camissa Asset Management. This morning we will talk to you about our unconventional positioning in our equity funds, explain a bit about our process and what we've been achieving over the last year, and then very importantly discuss some of our very exciting investment opportunities that we have in the portfolios as well, both in our domestic portfolio and also in our global portfolio as well. To start off in terms of our agenda, I'll recap in terms of our firm, what we've been delivering over the last year, and in particular the firm's history in terms of our investment team, the investment that we've made in our investment team in terms of new hires, and also elaborate in terms of our assets under management as well. We will be discussing our performance of the portfolios for the last year and then have a closer look of our global portfolio, the exciting investment opportunities that we see both in the domestic market and in our global universe. And then lastly, rounding out our presentation, looking at our yield assets, in particular the Sukuk market in South Africa, where we're seeing inflation-beating returns for the next year, but also over the next 5 to 10 years as well. So please join us in this presentation, and this will be made available to you by email after this presentation as well. So kicking off in terms of our normal presentation format, I'll give you a brief update of our company, Camissa Asset Management, what we've been doing in terms of our investment team, the investment in our team, and who we are, and the business that we've been expanding over the last 2.5 years since our name change from Camissa Asset Management that happened about 2 years ago. So as many of you would know that have joined us on this call, we have been an independent active portfolio management company for the last over 20 years. We had a name change, as I've mentioned, from Camissa Asset Management to Camissa Asset Management, and currently we manage about 66 billion rand of assets under management. This is spread across institutional investment holdings in terms of institutional clients, but then more importantly our retail business, both our conventional and our Sharia businesses have grown quite strongly over the last couple of years, especially on the Regulation 28 or pension fund and retirement fund space as well. As many of you would know, our income fund, our high yield fund has grown quite significantly over the last 18 months or so, and currently is our fastest growing fund in the stable as well. We are a true high conviction active manager. What that basically means is that effectively we are not afraid to steer away from benchmarks. Our portfolios are very differently positioned compared to larger managers and especially the benchmark as well. And that can be difficult sometimes, especially over shorter periods when we underperform. But as I'll show you over the long term, that has resulted in significant outperformance for you as our clients and for our broader investor universe as well. Our stable investment team has delivered very strongly over the last 2 to 3 years. And as many of you would know, we've had a trainee analyst program that we've run for the last 15 years. So excitingly, we have done a few promotions in our investment team. So over the last 18 months or so, we recruited trainee analysts into our investment team, and 2 of those trainee analysts have been promoted to associate analysts within our team as well. So collectively, we've got a team of over 20 people that have a collective investment experience of over 170 years as well. Our Equity Alpha Fund reached a significant milestone earlier this year, where it achieved 20 years of investment performance. That fund started in April 2004 and is the 4th best performing fund over that 20-year period. It's delivered 15.1% per annum returns over that period, and significantly the same investment philosophy, the same team, and the same investment approach that is applicable to our Equity Alpha Fund is deployed in our Islamic funds as well, and you as our clients are benefiting from that as well. Looking at our fund range, as many of you would know, we have launched our income fund, our high yield fund, just over 3 years ago. And in our view, this completes our fund range for Sharia investors. On the slide, you can see the fund range, and we look at it from a risk point of view. So starting with the low risk fund, which is our income fund, the Camissa Islamic High Yield Fund. That fund has grown significantly and really is suited for those investors that are either closer to retirement, looking for a safer alternative to high risk equity exposure, but also because it is Regulation 28 compliant, it does allow you to have exposure to the fund in terms of pension funds and retirement funds as well. Our other Regulation 28 compliant fund is our Islamic Balance Fund. This fund has now achieved over 10-year track record as well. It is the best performing Sharia balance fund in its category. Our long-standing fund, our Camissa Islamic Equity Fund, this fund was started in 2009. It now has a 15-year track record as well. And more recently, our global fund, the UCITS fund that we launched 5 years ago, and then our feeder fund that was launched about just under 4 years ago as well, completing our fund range and our fund offering to you as investors as well. These funds, as you would know, are available on the conventional side as well, where we have our Equity Alpha Fund and then our UCITS fund, and then also our conventional stable and balanced funds and Protector Fund as well. It's been a busy year in terms of awards. Earlier this year, I flew to Jeddah where I received the CIFA Award. That's a Cambridge Investment Fund Award for our Islamic Balance Fund and then also for our Islamic Equity Fund. Earlier this year, the Islamic Balance Fund won the Definitive Lipper Award for long-term performance. That's for 15-year performance. Beating all the other domestic balance funds in that category as well. And as you can see, that has been a trend for the last number of years, starting in 2018, when we won some of the Raging Bull awards as well. So over the last 6 years, consistently every year we've achieved fund awards and recognition of the performance that we've generated across most of our funds, but in particular our Islamic Balance Fund for you as investors as well. We have been investing in our investment team, so our trainee analyst that joined us about 18 months ago, there has been some promotions and some movements in that area of our investment team. And no significant changes to our senior investment team. So the senior investment team have now all been working together for well over 15 years. And as you can see on the slide, the years at Camissa Asset Management in terms of the green bars, quite substantial as well. And then also additional investment experience. We have over 170 years of investment experience working together, and that encompasses both significant market turning points. We had the global financial crisis in 2008, what I call the big COVID crisis of 2020, and more recently the geopolitical heightened tensions that have resulted in significant volatility in markets as well. Another point to note is that education and training and development is quite critical for us. As you can see on the right-hand side of the slide, our CFA count of 10 colleagues will be going up to about 12 to 14 over the next 18 months to 2 years as some of our more junior colleagues achieve their CFA chart as well. And this is very important for us. Our investment approach, which is active and bottom-up, requires us to have individuals in our investment team, investment professionals that have the technical skills and abilities and qualifications to execute in terms of our investment philosophy and process as well. On the Sharia investment team side, there has been no significant changes. I'm still the senior portfolio manager on the Sharia funds. I'm ably assisted by my 2 colleagues, Jihad Javeri, who assists on the global UCITS fund, and then also in terms of our global equity allocations as well. And then Aslam Dalvi, that's been a stalwart of the company for over 20 years. He covers the risk elements of both of our Regulation 28 compliant funds in terms of the Islamic High Yield Fund and then also the Islamic Balance Fund, and then also broader risk management, given his experience in risk management previously at Coronation as well. Abdul Davids Oldie completes our Sharia investment team. He's our Sharia analyst. He does all of the interaction with our Sharia board and then also is responsible for calculating the non-permissible income that gets distributed twice a year as well. Just a quick note on non-permissible income. Over the last 6 months, we've had a significant milestone in terms of the amount that has been distributed, over 4 million rand on behalf of our investors, distributed to various charities, about 40 charities in total. One of the substantial amounts that was allocated was to Gift of the Givers. As we know, that organization do fantastic work, not only in South Africa, but globally as well. So they have been one of the larger beneficiaries of the non-permissible income that we've been distributing as well. And I think over the last 15 years, since the inception of our Islamic Equity Fund, we've distributed now over 30 million rand in charity on behalf of our clients and investors as well. So thank you very much for your support that has enabled us to do significant change and investment in social initiatives in South Africa on behalf of our investors as well. So that was a brief update about the company, our investment team and our funds. I wanted to now get into the meat of our presentation, which is a deeper look into our investment Islamic fund positioning, and in particular unpack some of the reasons for the shorter term underperformance. One of the key culprits have been 2 stocks in particular, MTN and our PGM or Platinum Group Metal positioning, and I'll unpack some of that. but then also to give you a sense of how we look at our portfolio and to effectively slice our portfolio into 5 slices of roughly 20% each, where we unpack the various drivers and themes that are at play in terms of those 5 buckets or slices as well. So the next couple of slides will highlight that. But before we get that, it's important to recognize that if you look at our fund approach in terms of our philosophy and process, it is very different to what is being done outside of our company in terms of the broader market, and also in terms of positioning from a benchmark point of view. We call it unconventional, others might call it contrarian investing, and in particular what contrarian investing is all about is to look at opportunities that might be out of favor in the short term, might be areas of deep pessimism where nobody wants to look, and hence in terms of the picture on the screen, the fisherman fishing in the ice, it can be quite lonely, it can be quite cold. So it is sort of a bitter experience that one has to go through, but the rewards can be outsized. Because nobody's fishing where we're fishing, it does mean that you have a lot higher fishing capacity and catch available to you as well. So short-term underperformance invariably followed by long-term outperformance, and that has been our signature in terms of our performance signature over the last 15 to 20 years as well. So currently we think the market is quite exciting in terms of South Africa. There's substantial value to be unlocked and have for clients in terms of our portfolio positioning. Admittedly, it has cost us in terms of short-term performance, but as the next 4 or 5 slides will show, we are heavily invested in these positions. We think there is significant upside potential from some of these holdings as well, and we'll go through that in the next couple of slides. We've divided our South African equity holdings into 5 slices, effectively 5 buckets. And the 5 themes that we've unpacked is firstly companies that are operating well with good price momentum. I call them the rock stars. They're doing particularly well in the market. These are companies that have been rewarded with high share prices, and we think in the short to medium term there is still more upside potential for them as well. The second bucket are those companies that are operating well but are fairly lowly rated. What that typically means is that they are smaller companies with market capitalizations typically under 8 to 10 billion rand. So as a result, the larger investors, the foreign investors, are not looking at those opportunities as we are looking at them. And as a result, the financial performance is not recognized by the market. So these are companies that have excellent management. They've come through the headwinds of load shedding, the energy crisis that we've had in South Africa, and also the COVID crisis, and it delivered stellar financial results for investors. But unfortunately, the market is not recognizing that performance. The third bucket are companies that are operating well, but have some near-term challenges, either because of lockdowns or because of the energy crisis or load shedding. Still some of those remnants in terms of the higher cost bases or lack of revenue growth as a result of that, because South Africa's growth has been moribund in terms of the last 2 to 3 years. So as a result, the performance that we anticipate for these companies are well below par at the moment, but we see substantially higher financial performance from these companies over the next 3 to 5 years as well. So some near-term challenges, but longer-term still fairly rosy prospects as well. The fourth bucket are those companies that have low ratings, low cyclical earnings, and have some cyclicality to the earnings profile as well. And unfortunately, this is a global theme. We see it globally where companies that have cyclicality to the earnings, be it commodity or materials companies or be it financial companies, are frowned upon. Nobody wants to invest in them because it's very difficult at the moment to almost time the cycle. And the business cycle has been juxtaposed with a geopolitical element as well. And as a result, it's very difficult for investors to effectively determine where we are in the business and economic cycle as well at the moment. So these companies are indiscriminately sold off because earnings have been too volatile or too cyclical, and as a result, you've got a situation where earnings are low and the rating applied to that earnings is fairly low as well. The last bucket are really the problem kids. These are companies that have severe near-term issues. So in this bucket, you'll find the likes of MTN and the PGM miners, where we've known the issues, and we'll unpack them in the next couple of slides, where some of those issues have been near-term but very severe. And as a result, we've seen excessive volatility in terms of the earnings from these companies. But we firmly believe that the long-term fundamentals are fairly strong and fairly sound. And as a result, if one looks through this period of shorter-term volatility and near-term issues, we see fairly strong longer-term fundamentals that should result in a substantial re-rating and increase in fair value for these companies as well. So that in a nutshell are the 5 buckets, and the next couple of slides we'll go through them fairly quickly. But very importantly, our contrarian orientation means that all of these 5 buckets have elements of pessimism attached to them, and as a result they are not realizing their full potential, either in terms of earnings or in terms of the rating, and as a result we have them in the portfolio, as we still think that there's substantial upside to them as well. So the first bucket, as we've mentioned, are what I would call the rock stars, those companies that are operating well with good price momentum. That currently represents about just under 70% of our equity portfolio in South Africa. On the right-hand side of the slide, you'll see what we call the weighted undervaluation. That is approaching about 30%. So these companies on average should give us about a 30% upside by having them in the portfolio. I'm not going to go through all the names. I'll just pick out a few to go through. On the slide, you can see the likes of Datatec. That's the global IT company that just happens to be listed in South Africa. They've got the 2 divisions, Westcon and Logicalis. They're doing fairly well, but still not realizing the full potential in terms of a rating, partly because it's a fairly small company by global standards, sub 10 billion rand of market capitalization. And as a result, the larger investors, in terms of dollar investors, still below $1 billion in terms of the market value, being overlooked by global investors. So company is doing well, but not achieving the rating that they deserve, trading at around 10 times earnings at the moment. The next one is Oceana. Oceana, the fishing company, it does have a large shareholder, so liquidity is an issue for this company, but again, trading on fairly low P multiple, around 5 times P multiple, paying a very decent dividend. They've had fairly high fish prices, especially in the US, and benefiting from those. We see that enduring maybe for the next 18 months to 2 years before it reverts to lower levels. But nevertheless, on a 4 to 5 PE multiple where this company is trading, we think it's substantially undervalued at current levels. The third company I wanted to talk to in this slide is Pepkor. Pepkor has done exceptionally well over the last 2 to 3 years, especially coming out of the COVID pandemic era. And more recently, they've done a transaction with Shoprite, where they've bought the furniture business from Shoprite. The company earnings have grown significantly over the last 2 to 3 years. The rating has increased to about 17 times, but we think that there is still some more opportunity in the likes of Pepkor as well. So as I said, this is the rock stars in terms of those companies that are operating well with good price momentum as well. The second bucket are those companies that are operating well, but they have fairly low ratings, and that typically is because they are fairly small. So in this bucket, this represents just under 12% of our equity portfolio, weighted upside of just under 40%. And in this bucket, we've got the likes of Omnia, the chemical company. They've got a business in Australia that does humates, which is a type of fertilizer. And literally, they are on the cusp of achieving global exposure with this business. They've recently signed contracts with Brazilian agriculture players to globalize that business out of Australia. And we think that that is the hidden gem in Omnia. It's substantially undervalued in that business. If you look at the current rating of Omnia, around 10 times earnings, with this business almost achieving a 0 rating at the moment, given its undervalued and capacity to grow earnings into the future as well. The second company is Curro, the schooling business. They've had a challenging period coming through the COVID pandemic, but we believe that earnings are now on a recovery phase. And with the recovery in earnings, we see meaningful appreciation in terms of the earnings growth over the next couple of years. So the current rating looks a bit high at about 15 times, but we believe that earnings growth will be substantial over the next couple of years as well. The last company in this bucket is Exxaro. It is a complicated company in the sense that it has an iron ore business, the iron ore exposure through the holding via Kumba Iron Ore, and then also the coal business. And unfortunately, we've seen globally and in South Africa as well, coal businesses or energy businesses like this, because of ESG and because of various factors, being fairly lowly rated, typically 4 to 5 PE multiples. In our view, clearly there's a risk, and we assess the ESG issues with these companies. But to the extent that they're delivering earnings and you can get a 20% return, which effectively is what a 5 PE multiple is giving you, we think that those risks are fully accounted and discounted in the current share price, and we see substantial upside in the likes of Exxaro as well. Moving on to the third bucket, these are companies that are operating well with some near-term challenges. So in particular, those near-term challenges either stemming from previous headwinds, the likes that we've seen in South Africa, which is peculiar to South Africa, which has been the lockdown initially from COVID, and we still see some of that remnants of that in the economy and the economic scarring from that. But more importantly, the impact of load shedding. And this is where a lot of companies have had to make investment in terms of alternative energy, be it inverters or be it renewables like solar, for example, or they've lost out on revenues in terms of their bucket. And that is particularly true of the smaller companies, the packaging companies. They've had to make additional investments in terms of security of energy supply, either in terms of the inverters or in terms of renewable energy. But more importantly, they've lost out in terms of revenues as well. So the likes of Transpaco, Bolo Metcalf, they've lost out on revenues because of the impact and the lower economic growth that we've had in South Africa as well. In this bucket, we've also included Anglo American. Anglo American is operating well, especially in terms of the copper business, but they've had some near-term challenges in terms of their PGM business. They are the majority shareholder in Anglo Platinum, and we've seen the weakness of Anglo Platinum manifest itself in terms of Anglo American as well. These companies have a weighted upside of approaching about 50%. So we're quite excited. We think that these companies are delivering fantastically, and holding them over the next 4 to 5 years will see substantial unlock of value for investors like yourselves as well. The fourth bucket that we wanted to talk about is those companies with low ratings and effectively are cyclical companies. They are at the cyclical low, and the long-term fundamentals are fairly strong and fairly sound as well. This represents about 11.5% of our equity portfolio, and you can see the weighted upside in terms of the right-hand side of the slide, approaching almost 60% as well. So this cohort of companies have some unique characteristics, but they also share some similarities as well. And the similarities that they share are that they're all smaller companies between 600 million to 2 billion. At the highest level, you've got PPC, maybe at about 5 billion market capitalization, but they are all on single-digit PE multiples. So in the South African context, if one looks at South African valuations over the last 30 years, when you've had companies on single-digit PE multiples, you can almost close your eyes and just buy them, hold them for the next 10 years, and you will more than double your money from those type of investments. That's been the experience in South Africa, and we think that you're at a similar inflection point in South Africa for these companies as well. So they're all, maybe PPC the one notable exception, in that they've been able to turn around their business in an environment where the infrastructure spend and GDFI spend in South Africa has still been constrained. So cement demand has been fairly low in South Africa, but notwithstanding that, they've been able to reduce their debt on the balance sheet. They've disposed of their African operations and paid out substantial dividends to shareholders during that environment. All these other companies on single-digit P multiples with fairly strong earnings potential as the economic cycle turns in their favor as well. Coming to the last bucket, and this is where I want to spend a bit more time talking about them, and we will unpack some of this a bit later in the presentation as well. These are companies with what I call the problem kids, severe near-term issues, but with strong long-term fundamentals. It's quite a sizable part of our portfolio at about 21% of the fund in terms of our equity fund, and you can see the weighted upside approaching 100%. So these are companies that could easily double from current levels, and this is probably where we see the most pent-up upside and expectations for upside in our equity portfolios as well. And right at the top, the likes of MTN, it is our largest holding in the portfolio, both in terms of our equity fund and also our Islamic Balance Fund. And the reason for that is that over the last year, we've seen MTN halve. It was at about 170 Rand in terms of its share price about a year ago. It's halved and actually went to below 80 Rand a share recently. Currently trading at about 85 Rand a share. And I will unpack MTN a bit later in this presentation. But suffice to say that the Nigerian Naira and the Nigerian issues has really played havoc with MTN in terms of its share price, and we'll cover that a bit later. The other big theme for our portfolios has been the PGM exposures that we've had, both in terms of Northam and Anglo Platinum. We have seen a very strong spurt in terms of growth for electric vehicles. So sentiment towards PGMs, in particular the platinum and palladium markets, that feed directly into the automotive market has really been quite negative over the last 18 months. Our interactions, and as I'll demonstrate in a few slides' time, have indicated that the EV market has cooled substantially over the last 12 to 18 months. And as a result, we see a very strong growth spurt coming back in terms of PGMs, in particular platinum, as the hybrid vehicle market starts to recover and take off in quite a big way as well. Lastly, Mete, fairly similar to the automotive exposure that we've had in terms of the PGMs. They do the stop-start batteries, their Rombat business and their Mutlu Akku business in Turkey has had their challenges. They've had exposure to the Turkish market that has seen fairly high interest rates and fairly high inflation as well. So on translation, a lot of those results have been quite a big detractor to the South African business as well. And as a result, Mete has substantially underperformed over the last year as well. These are the problem kits in the portfolio, roughly about 21% of our equity portfolio. But outside of our equity holdings, there has been companies that we've had zero weights in that have either delivered fairly decently in terms of share price performance, or that are quite substantial in the benchmark that we've had a zero weight in. We believe that these companies have downside risk, and this is quite important because part of our responsibility to our clients is not to only generate investment returns, but it's also to avoid losses as well. By having exposure to these companies, you will actually have the risk of capital loss as their share prices start to fall and value starts to erode from these businesses in particular. Top of the list, we think that the gold companies in particular in South Africa, we've seen a very strong spurt up in terms of the gold price. It's more than doubled over the last 18 months. From levels of about 1,500 to 1,700, it's touched 2,600 and currently above $2,600 per ounce at the moment. A key driver of the gold market has been central bank buying, in particular the Chinese and Turkish central banks. We have seen very recent data that they've started to slow their buying and in some cases stop buying, and we believe that that could be quite a significant catalyst for a decrease in terms of the gold price, given the absence of that fairly large, almost price agnostic buyer in the market as well. Unfortunately, South African gold companies have lagged the gold price for two reasons. Firstly, they've had fairly high cost bases, and as a result, the cost bases have gone up and they've actually grown much faster than the appreciation in the gold price. And secondly, we've seen that poor capital allocation has resulted in very little dividend flow and returns to shareholders, even in an environment where gold prices have been very high. So we believe that the mixture, or what I call the lethal cocktail, of lower gold prices coupled with poor capital allocation and stretched balance sheets for these gold companies could result in substantial capital loss for investors as gold prices start to retreat, and hence we don't have any gold exposure in the portfolios. Just a word on BHP. BHP does have some gold exposure, but they also have fairly large iron ore exposure. They are the world's biggest iron ore producer, and we see downside risk to iron ore prices. The iron ore market is fairly dependent on the Chinese property market. We have seen the property market in a state of flux in China. Coming out of COVID, quite a significantly weaker market in terms of the property market there. There has been attempts to stimulate that market, but to date we haven't seen a successful re-stimulation of the Chinese property market, and that is potentially quite negative for iron ore prices. So we are cautious and wary on having any exposure to BHP as well. I wanted to delve a bit more deeper into two of the problem kits. Those companies were severe short-term issues and headwinds. Probably the single biggest detractor to our performance over the last 12 months has been MTN. It is also our biggest holding. So the next couple of slides will really just unpack the investment case for MTN, identify what were the issues that resulted in the weaker share price for MTN, and then the good news in terms of the longer-term outlook, where we see value in MTN, even incorporating the current shorter-term headwinds as well. As I've mentioned, the main reason for MTN's weaker performance has been Nigeria, and in particular the Nigerian Naira. So what we've done is really just look at the key fundamentals of MTN and to remind ourselves and you in terms of why we like MTN. Firstly, MTN is one of those unique African telco companies because they operate in 21 different countries, mainly concentrated in Africa. They almost have unparalleled exposure to the key demographics of Africa, which is a growing population. This is quite unique in a global context. Many other areas of the world are seeing declining populations, but also their demographic that is most likely to go into an income earning phase, that 18 to 35 cohort, MTN on a global basis, probably the most exposed to that demographic as well, as we highlight on the left-hand side of the slide. From current levels, the demographic exposure of MTN in terms of the population that it can serve can double to 2050, from about 600 million people currently to over 1.2 billion by 2050. That is a significant tailwind for companies like MTN to grow their top line and to grow revenues as well. The next, the middle part of the slide is fairly busy, but it just highlights the footprint that MTN has. Out of that 20 odd countries that they operate in, they have had significant investments since about 2001 when they entered the Nigerian market. In terms of the infrastructure in Nigeria, they call it the yellow band, for example. That has had significant investment from a capital point of view, from an infrastructure rollout, akin to what a fixed line operator would invest typically in terms of fixed line rollouts as well. So that is a tangible investment that they've made over many years that effectively should result in a harvesting and substantial returns being generated from that infrastructure spend as well. Lastly, on the right-hand side, you can see what we call the multiple growth drivers, be it the traditional voice and data businesses, but then also mobile money, which they've rolled out in many of the African operations, and then ancillary services, financial services type products that they do have available to their customers that they serve across most of those geographies that they operate in as well. So clearly, one issue that we need to address is Iran. So MTN does have the Iranian business. We put a zero value on that business. It does give them optionality. The substantial cash that is actually trapped in Iran, which that business is up for sale. In a worst case, they get nothing out of Iran. The business is self-funding, so there's no money going from the head office into Iran. But the likely scenario is that they will be able to get and extract some value out of Iran over the next 12 to 18 months, even if it is just the 1.8 billion of cash that is trapped in that business as well. But as I said, we put a zero value on that. Clearly, the current geopolitical tensions in the Middle East warrants quite a punitive valuation on that business as well. And then they do also have exposure to IHS. That's the tower business, or the tower infrastructure company. That was spun out of MTN when they sold the towers to IHS. They do still have an equity stake in that business that could be monetized and used to reduce the debt on balance sheet as well. So that, we believe, frames the investment case for MTN. What we have seen over the last year and what we have on slide is the Nigerian Naira. So the Naira to the dollar in terms of the exchange rate, you can see for a long period of time it was hovering around 400 Naira to the dollar. And we just wanted to highlight a few data points on this graph. The advent of the current President Bola Tinubu, he won the election in April last year, was appointed, and he set about achieving some economic reforms in the economy of Nigeria. And chief of this was firstly to harmonize the exchange rates. So Nigeria, similar to what South Africa had in the late 80s, early 90s, was a dual exchange rate system. So you've got what they call the black market rate and the official rate, or the parallel rate. Effectively, there was an increment of about 500 differential. So whilst the official rate was at about 400, the black market rate was at about 700 to 800. And what he set about doing was to achieve economic reforms, to harmonize these exchange rates. And critical to this was to achieve government savings. First, in terms of the fuel subsidy, Nigeria, despite being a fairly large OPEC producer, still had fuel subsidies for consumers in the domestic market because they don't have refining capacity locally. So fuel prices are fairly high in Nigeria. And to compensate the working class, there was some fuel subsidies that was removed in the Nigerian market late last year. As I've mentioned, they've done the unification of the exchange rates and then also interventions in the oil market as well. So the oil market has been beset with problems in Nigeria. Firstly, we've had regular attacks and sabotage of oil infrastructure, but there's also been large-scale theft and pilferage that has happened in that market. So they've tightened up on that market. They've actually brought in the Saudis to help them reform that market and to invest in the market, and we believe that that will yield substantial results for them. To the extent where Nigeria's oil production has already doubled from last year's levels, from about 600,000 barrels a day last year to about 1.2 million barrels a day, and they're well on track to achieve the short-term target of 1.8 million barrels a day of oil production. We believe that that will set them on the path for fiscal discipline and fiscal consolidation. That should be very positive both for the exchange rate, but then also for the inflation rate as well. Part of the problem with Nigeria in terms of the economy has been the fairly high inflation rate. The inflation currently sitting at about 32%. But that's down from the 34% previously about 2 to 3 months ago. And part of the reason for that is that the central bank governor, they have raised interest rates by about 8%. And so current interest rate sitting at about 27% has cooled the inflation burden on the economy, but also we believe should be positive for the medium to long term exchange rate as well. So currently the exchange rate is sitting above 1600 naira to the dollar. And we've passed various scenarios. A scenario where the spot remains in place for an extended period of time, a scenario where it weakens from current levels, and then also a scenario where it strengthens as well from current levels. So on the slide, you can see our valuation framework for MTN. That incorporates a fair value for Nigeria of about 12 Rand. And excluding that, clearly that will knock the fair value a bit. But from current levels, we still see a fair value of of MTN of about 150 Rand a share, which is sort of the ballpark, fairly conservative valuation framework. If one incorporates some targeted price increases in Nigeria, where admittedly, if your inflation is running at 32%, you need to allow telco companies like other companies to increase prices. We think it's just a matter of time before we see those price increases coming through. That can add a further 24 Rand to the valuation. And also assuming and painting a scenario where the Naira strengthens back to 1,000, bearing in mind it was 400 for an extended period of time, that will add a further 55 Rand to the valuation as well. So one can easily build a case for seeing a fair value for MTN of close to 200 Rand a share with those scenarios in place as well. So at current levels where MTN is trading at about 85 Rand, there's more than double value in terms of MTN. But even taking a conservative view and saying Nigeria will remain broken forever, discounting the MTN Nigeria business completely, we see upside to about 150 Rand. That is almost a doubling from current levels as well. So that's the story in MTN. Maybe moving on to the PGM miners. This has been another area where we've seen severe underperformance in the short term. And that's mainly because of sentiment. The fundamentals of this market remains fairly healthy and fairly strong. PGMs are not natural to the earth. It's basically because of meteors that have struck select areas of the world. In South Africa, the western limb of the Bushveld area. There's been places in Russia, in the US. And those are probably the three major areas where we find PGMs on a global scale. Unlike iron ore and unlike copper and gold, that is more widespread across the world. South Africa, Australia, North America, and then Russia are the three major areas where you find PGMs. And as a result, these metals are fairly unique, fairly limited in terms of the availability and supply, but also very important in terms of the markets that they serve, be it the jewelry market in terms of platinum jewelry, but more importantly, the automotive market that serves roughly a third of the market in terms of its applications as well. So the current market dynamics where we've seen negative sentiment, a cooling down in terms of the automotive market, but then also reduced supply as mines have been struggling to keep mines open, especially in South Africa, but also because of high costs in North America, we see those dynamics being quite fluid at the moment as well. And we'll unpack that in the next slide. So in this slide, we're looking at the future market dynamics for PGMs. First, in terms of demand, we think demand will remain resilient. We have seen over the last 2 years the impact of COVID in terms of automotive production. The large German OEMs have struggled to keep factories open amidst the COVID pandemic. As those factories have had to reopen, production was slow to restart. In contrast, we've seen fairly strong growth in automotive production out of China. And China has really taken over in terms of global market share from some of the German and even the Japanese automotive manufacturers as well. So passenger cars has been, and key to China has been the growth in terms of electric vehicles. And as a result, we've seen a slowdown in what we call ICE or internal combustion engine vehicles and a higher growth rate in terms of EVs coming out of China. More recently, we have seen the EV market slow down quite substantially. That's because of two things. Firstly, higher costs, and European and Western economies not making those subsidies available for EVs anymore. But then also what we have seen is that the Chinese EV producers have found it very difficult to export their vehicles given high tariffs in Western economies and in the US in particular. So the EV market has cooled substantially, and we've seen a commensurate decrease in terms of the share prices from some of these EV producers and suppliers as well. Secondly, emission legislation in terms of both China and Europe have resulted in a structural step up in terms of demand. So as a result of emission legislation, loadings had to increase for a lot of these companies and for a lot of the OEMs, and that requires them to use more PGMs, especially platinum and palladium. In China in particular, heavy-duty diesel has resulted in a step up in terms of loadings. We believe that there is an element of cheating similar to what we saw with the VW scandal a few years ago. But nevertheless, we should still see high loadings coming through from China, which should be positive for demand as well. Jewelry production is much lower, and this is much more of a sentiment issue. Lower platinum prices makes it actually less attractive. People want to have exposure to jewelry that appreciates in value. So we've seen this over the last 20 years. When platinum prices fall, jewelry demand actually falls, which is counterintuitive, because the jewelry should actually become a lot cheaper. But there is an element of sentiment to it as well. So the jewelry production being lower is much more functional of the lower prices as well. And then I think medium to long term, the hydrogen market is nascent, but it's really a substantial opportunity for this market. We are likely to see beyond 2040 a substantial component of demand coming from hydrogen, as we unpack in a few slides' time as well. So that's on the demand side. Moving on to the supply side, mine supply has been declining, as we know, for the last 5 to 10 years. South African miners in particular have not been investing in new mines. There has been some consolidation in our market, with Sibanye, for example, buying the Lonmin mines, and previously some of the Aquarius mines as well. So consolidation in the market, lower investment in actual mine supply, means that we are likely to see lower supply over the next 3 to 5 years. In addition to that, we've seen further capex cuts as commodity prices, especially the platinum price and palladium price, have moved lower as well. So we think that that dynamic of potentially more resilient demand coupled with lower mine supply should be positive for medium to long term platinum and palladium prices. Additionally, we've seen recycling being quite challenged. Quite a few of the recyclers has gone out of business or has seen consolidation in their markets, most notably in North America, but also in Europe as well. So recycling being challenged, that's just a source of additional supply. And if that supply component is not there anymore, that is also quite positive for pricing as well. The next slide is quite busy, but it's really looking at vehicle production from 2019. So over the last 5 years, and then extending that to 2030. And this is from one of the data providers that we have access to, and it stratified the market between light duty ICE, or traditional internal combustion engine, and then looking at the various other components from heavy duty diesel, the fuel cell vehicles, which sort of come in towards the tail end of this graphic. But then more importantly, you can see the light duty hybrid market also being quite a big feature. So from where we are, you can see the dotted line, 2024, light duty hybrids, a fairly small component of this market, roughly about 10 to 12 million vehicles currently, but growing quite substantially. We estimate to 25 to 30 million vehicles by 2040. That is probably the key to the investment case from a demand point of view. As the world transitions away from ICE, you can see ICE was at about 80 million vehicles in 2019. That is expected to more than halve to below 40 million vehicles by 2030. But hybrids, because of the higher loadings that are required, especially from a platinum point of view in the hybrid market, that is actually net positive for PGMs and platinum in particular, notwithstanding the lower ICE vehicles being produced by 2040 as well. So 2 observations from this graph. Firstly, we don't expect ICE to disappear completely. As you can see, we still expect roughly about 35 million vehicles to have ICE motors by 2040. And that is consistent with the next couple of slides that I'll show you, which is really around the sentiment towards ICE that has been changing. But then more importantly, we think that the hybrid market achieves 2 goals. Firstly, it achieves greater fuel efficiency and less impact on the environment, but also it overcomes the problem that is persistent with electric vehicles, which is around infrastructure rollout in terms of charging stations, in terms of the infrastructure required to enable mass adoption of electric vehicles. Because you've got a hybrid vehicle, you've got the elements of EV in terms of the battery, but you also have the element of fuel that is required as well in the absence of the large-scale adoption of infrastructure as well. So we are firm in our view that hybrids will be the panacea that will solve the problem of firstly emissions on the one hand, which is a problem with ICEs, but then also overcoming the infrastructure challenge that electric vehicles has in terms of government's inability or unwillingness to invest substantially in charging infrastructure globally as well. This graphic is really just to highlight the very near-term sentiment and the changing sentiment that we've seen. So a couple of years ago, we've seen most European countries and Western economies being quite enthusiastic about EVs, talking about adopting a green plan and adopting a 2050 plan for 100% EV vehicles. The reality is that costs money. And capital hasn't been available, especially in an environment of high interest rates and high inflation. So as a result, there has been severe pushback, firstly from the IC manufacturers in terms of saying that there's no subsidies, there's no charging infrastructure, we can't roll out EVs if the consumer does not want it. And then secondly, in terms of the pain that has been accompanying the industry, because they're producing electric vehicles, but the customers are not buying it because the infrastructure is not available. So we have seen this demand slowdown hitting the EV market, and EV shoppers has also hesitated because clearly they know that if you're only going to get a 600 to 700 kilometer range on your EV and you don't have the infrastructure, that car is going to be parked in the garage most of the time. So we have seen an alternative in terms of the hybrid sales taking over as well, as we can see in this slide as well. And commensurately, the graphic at the bottom just highlighting the impact that this has had on the share prices of the likes of Tesla, and also in terms of EV unit sales as well. So clearly, the negative sentiment towards EV has translated into a higher uptake of hybrid, which is positive for the PGM miners as well. This slide is looking at automotive PGM demand. As we've shown you previously, the 80 million vehicles going down to about 35 million vehicles, and what that implies for effective PGM loadings or PGM ounces. So starting off at roughly about 13 million ounces in 2019, you can see we expect an initial slower and lower sort of number coming through, but then it actually reverts back and exceeds 14 million ounces by 2027. Before gradually declining back to current levels as well. So ultimately, we believe that notwithstanding the much lower ICE or internal combustion engine vehicle production, going from 80 million in 2019 down to about 35 million by 2040, the actual ounces required to produce ICE, hybrids, and other sources of demand will result in a fairly stable to moderately declining PGM ounce profile from a demand point of view as well. The second and more important longer term opportunity for PGMs is in terms of hydrogen, both in terms of protein membrane or what they call PEM electrolysis. These are fuel cells that require PGMs to produce electricity and to produce energy. And then also in terms of the transformational impact that transportation of hydrogen will have. So there has been new development in terms of liquid hydrogen transportation or carriers, or LOHC. That is a fairly transformational new technology that enables most infrastructure providers to overcome the big hurdle of how to transport hydrogen. As we know, hydrogen is quite a volatile gas, and as a result, your infrastructure investment is quite substantial in terms of how you transport it. But this LOHC effectively overcomes this quite smartly as well. And then lastly, from a usage point of view, your infrastructure similar to EVs required for hydrogen charging stations, those are still in its infancy, but we believe that the medium-term to long-term use case for this is fairly solid and fairly robust as well. So this is nascent, it's a market that is still in its infancy. One can easily toggle this and say that this market could grow 20% lower, 30% lower. It doesn't have a material impact in terms of demand to 2040 that we see as well. And so to conclude in terms of the PGM discussion, if you look at mine supply, We see this element of mine supply, as we've mentioned, declining slightly, especially with lower South African mine supply, but then gradually taking up again in terms of hydrogen. The hydrogen on the right-hand side of the slide, you can see, is quite a big component of it. But if one ignores and takes that away completely, we see industrial and jewelry demand effectively being at similar to levels to where we are now in 2024. So the 2040 demand kicker really coming through from hydrogen, which would be a cherry on top and would result in substantially higher platinum and palladium prices compared to where they are currently as well. So moving on to global equities, what we have in this slide is our global equity fund geographical exposure versus the benchmark. And as you can see, we are substantially underweight US equities. And that's mainly for two reasons. Firstly, in terms of our global portfolio, we're looking at opportunities on a global basis. We are finding less opportunities in the US market compared to the benchmark. The benchmark has a substantial weighting to high-tech IT companies, what we call the flavor of the month type companies. These are your NVIDIAs, the Microsofts that are substantial in that benchmark. And we actually think it's unhealthy for a benchmark to effectively have 70% and more than 70% in one geography and still to be called a global benchmark. So we are quite comfortable being substantially underweight the US. And in contrast, where we are overweight areas like Germany, the UK to a lesser extent, and more recently Japan, where we find substantial opportunities in Japanese equities, some of those industrial companies that we will unpack a bit later as well. So in this slide, we will just highlight a few of the actual company names that we have exposure to and the sectors that they operate in. On the left-hand side, you can see in terms of consumer discretionary, the likes of JD.com and Panasonic. These are consumer-facing companies. JD.com in particular, I will talk about in the next couple of slides. It has been a source of substantial underperformance more recently in our portfolio. But we are quite heavily invested in these, our biggest holding in the portfolio, and we think that there is substantial upside to JD.com, as I'll show you in the next couple of slides. We have lightened exposures in the likes of Philips, SKF, and Bodycote. These are companies that have done particularly well on the global portfolio. Coming out of COVID and the pandemic, they had periods of substantial earnings and rating and share price weakness. But as the COVID pandemic scarring dissipated, the earnings have recovered and rebounded, and we have seen a realization in terms of those fair values coming through as well. More recently, we've had an exposure to Nutrien. Nutrien is the world's biggest supplier of potash. The potash market, after quite a violent and substantially rising price in terms of potash, where potash prices breached $1,000 per ton, they've settled now at more reasonable levels, below $300 a ton, and Nutrien's share price has commensurately been fairly weak, and we've seen that as an opportunity to increase our exposure to Nutrien as well. As I've mentioned, JD.com is our biggest holding in the global portfolio. It has been a source of weakness given the weaker overall performance of Chinese stocks, but JD.com in particular. And we find that quite perplexing, given that JD has strong similarities with the likes of Amazon, and Amazon has been a retail juggernaut in the US market as well. So just unpacking the investment case for JD.com, it is the largest first-party retailer. What that basically means is it supplies and sells directly to consumers. It has a JD.com platform. But importantly, they do their own logistics. So the vertically integrated business model that they operate means that they capture higher margin for themselves, but also are able to deliver products more efficiently and, given the scale, more effectively compared to other players in this market as well. And we'll share some of these numbers that are just mind-blowing in terms of the amount of people that they serve and the type of products and quantity of products that they move as well. Fundamentally, we believe that the Chinese economy is on the cusp of fairly strong growth. There has been clear mistakes and missteps made, most notably in terms of the Chinese property market, but hopefully most of that is in the rearview mirror. More recently, there has been announcements around stimulus, which we think is quite positive for the likes of JD.com. Clearly, the risk is in the implementation of that stimulus and how that ultimately filters through to the Chinese economy. But the structural drivers of urbanization, higher growth in incomes for Chinese consumers, these are fairly strong tailwinds that will be positive for JD.com as well. We think that the investment that JD has made in terms of their logistics infrastructure, their platform, provides them with a fairly strong moat to differentiate themselves from other players, and also insulates and entrenches their leading position in the Chinese market. For any competitor to achieve the profitability that JD is achieving, they would need to make a similar investment in terms of what JD has made over the last 10 years as well. We think that management has executed fairly well over the last 5 to 10 years, and we can see that in the results. More recently, the quarterly numbers, fairly strong growth in top line in terms of revenue and also in terms of profits as well, as we'll show you. Ultimately, if one looks at the investment case for JD, it's around the attractive high return financial model that they operate. If you can achieve 60% EBITDA margins and fairly high return on invested capital, that is quite a decent investment. On top of that, if one looks at the current rating of JD.com, below 10 times multiple for a world-class business that is a rival to Amazon, but exclusively focused on the Chinese market as well. You can buy this business at a substantial discount to its intrinsic value. And importantly, JD.com also has quite a large investee portfolio. What that basically means is that they've got a lazy balance sheet of a portfolio of holdings that could be sold tomorrow, and you could almost realize 40% to almost 50% of the current share price or market value just by selling off those investee companies. The business would be totally unaffected by that as well. So there's very short-term real opportunity to unlock value for shareholders as well. The next slide is a bit busy, but it just highlights the substantial footprint that JD.com has in China. It is the largest e-commerce business, and some of these numbers are just staggering. 600 million people that they service in China. They've got substantial retail footprint across most of China. The rural areas that are not covered by them in terms of a physical presence get serviced via high-tech technology like their drones, for example. And most of the warehouses and factories are fully automated. So you've got autonomous vehicles that are doing, the running around. You've got small robots that are handling packages. All of that just to minimize, expense and to make it much more efficient as well. On the right-hand side, the investee portfolio of companies that they have represents almost 50% of the market value and can be sold off tomorrow to realize value for shareholders as well. This slide just looks at the expansive logistics network that JD has, and you can see some of the numbers that I've quoted. 1,600 warehouses spread across most of China. It is the #1 logistics provider in China, and they've got 32 million square meters of space that they operate out of in China as well. So most of the substantial cities, the larger mega cities, are covered by these infrastructure in China. And the next graphic you can see on the top left-hand side, an example of some of these drones. So these are drones that they operate, especially for rural areas, where you've got the fulfillment aspect, direct to your door delivery via drone, for example. Below that, an example of an autonomous vehicle that does deliveries as well. And then the big graphic in the center of the slide highlighting the small robots that does a lot of the package handling in these warehouses as well. So fairly low human interaction and worker requirement in these factories. And as a result, the running costs are fairly low as well. So if one looks at the business model of JD, where they've made this investment in the logistics network and in the platform, they then have suppliers that are delivering to them either to the platform or to the warehouses. And then also alongside that, they're supplying external companies, the large multinationals, pharmaceutical, FMCG companies globally as well. So they're leveraging off their network, and that enables them to become a lot more efficient. It enables them to procure product much cheaper than any competitor can. And by effectively servicing this 570 to 600 million people, they can deliver product much cheaper than anybody else while still achieving substantial and higher margins compared to competitors as well. And that virtuous cycle then repeats because customers get attracted to these better pricing and more attractive discounts. And that is quite appealing to suppliers again, and more suppliers then join the network as well. So we believe that ultimately this virtuous cycle is a continuous loop that will result in substantial growth in earnings and cash flows for shareholders, and you can buy this company at a substantial discount to intrinsic value as well. So what we've done in terms of our financial model for JD.com is incorporate some of the scale benefits in our models. In this slide, we give you a sense of what we expect profit growth to be in terms of the bars going from green to yellow, and the line representing the operating margin. We believe that after being loss-making in 2016, we've seen operating margins going positive above 1% in 2023, and we believe that operating margins can actually more than double, go back to 5%. That's really just a financial model in practice. That virtuous cycle just keeps on repeating, and those operational savings get reinvested into the operating margin, and profits grow substantially from current levels as well. Lastly, looking at JD.com from a valuation point of view, the main reason for the weakness in the share price has been negative sentiment towards Chinese stocks. We have seen the ADR, which is a stock that we've been buying in the US, being fairly weak alongside other Chinese ADRs listed in the US as well. So we don't think it's peculiar to JD that the share price has been weak. It's really a sentiment issue, and we understand and are cognizant of the geopolitical issues that affect China versus its relationship and standing towards Western economies. Notwithstanding that, we believe that fundamentally, if one can invest in a company that is delivering strong earnings and delivering value to shareholders, the rating will take care of itself. And more recently, with the announcement of Chinese stimulus, we have already seen quite a substantial increase in the rating of JD.com as well. So you can see the share price has already moved from a low of about $27 earlier this year. It's almost doubled, closer to the $50 level. But we believe that fair value closer to $85 from current levels as well. And that incorporates a portion, not the entire, just a portion of the investee portfolio in JD.com as well. The second company, just to round off our global discussion, that I want to talk about is Applied Materials. This is a fairly new addition to our global portfolio, focused on the semiconductor market, and we believe it is a semi-equipment champion in the US market. It is a market that is growing very fast, with the likes of NVIDIA and the graphics market, and also AI adoption being a significant catalyst for growth in this market as well. If one looks at the investment case for Applied Materials, it is a leading manufacturer of specialized semiconductor equipment. That effectively means that it's supplying quite a few of the customers and players in both the AI and Internet of Things type of markets. And those markets, as I've mentioned, are growing fairly fast. And it is one area of the semiconductor market that is expected to continue to grow well into the future. If one looks at NVIDIA and the statements that they've made, they still see substantial growth and scope for growth in that market from the wide adoption of machine learning and AI as well, especially generative AI as well. So this supply into that market is exposed to that fundamental driver, which we think is quite important to give our clients and investors exposure to that market as well. Ultimately, if one looks at Applied Materials over the last many years, given the high investment in research and development, they've been able to build a natural moat around their business and achieving fairly high returns on capital, over 40% ROEs, which is fairly substantial compared to competitors. Many of their competitors are achieving high single-digit to low double-digit ROEs. So the ROE profile or return on capital profile is a standout for us. And that is mainly because of the scale. So the investment in R&D that they've made over the last 5 to 10 years have enabled them to have substantial scale compared to competitors. And this is resulting in much higher returns compared to their competitors as well. So we like the attractive high return, high margin business model. And we think that because Applied Materials is trading at a discount to some of the larger and smaller players, you are getting a fairly high, attractive, high margin business at a substantial discount relative to peers in this market as well. This slide is busy, but it just highlights from the various steps how Applied Materials enable semiconductor manufacturing. I'm not going to go through the detail in this slide. It is fairly self-explanatory, but very importantly, you can see they're playing in 4 or 5 of these key steps in this 12-step process, which is quite material and is quite relevant to the key aspects of where we're seeing growth in this market, be it in terms of generative AI or be it in terms of the graphics opportunity that the likes of NVIDIA is exposed to as well. This slide just gives you a sense of some of the components that they actually make, and on the right-hand side, some of the markets that they are exposed to in terms of foundry, DRAM, the NAND market, and then also the packaging market. Packaging in particular, the requirements around packaging has improved and increased substantially with the growth that we've seen in some of these graphics and in semiconductors as well. So it's important to be able to play in these markets, and as you can see, Applied Materials is a leading player in some of these components as well. So based on our research, we see substantial growth in the semiconductor market, and we expect Applied Materials to also see commensurate growth in terms of their revenues, effectively about an 8% compounded annual growth rate to about 2030, resulting in further increases in profitability, further expansion in margins, and effectively you're seeing on this slide the margin expansion resulting in fairly higher return on invested capital as well. At the bottom of the slide, just dwelling on the return profile, we've seen ROEs above 40% currently. We're likely to see that move further higher to about 45 to approaching 50%, and then return on invested capital also much higher as well. Substantial portion of this return profile incorporate a fairly high R&D spend. So it is something that has resulted in substantial returns that they've achieved on that R&D, but it's something that they can actually turn off as well. So in the shorter periods of time, if the market is not growing, reducing R&D spend will actually result in high returns to shareholders in this market as well. Lastly, about Applied Materials, from a valuation point of view, despite having the leading ROE and ROIC metric in the industry and having potentially 8% growth in revenues for the next 4 to 5 years, it is fairly lowly rated. You can see here in terms of the slide some of the names that are peers and competitors in that market, and Applied Materials at a substantial discount to most of them as well. So it's a company that, as I've mentioned, we have added to the portfolio more recently. It's a market that is fast growing and a market that we believe will result in substantial growth as the semiconductor and also the ChatGPT and AI market continues to grow over the next 4 to 5 years as well. The last component that I wanted to talk about in this presentation is the yield assets component, in particular the Sukuk market in South Africa, where we are seeing fairly exciting inflation-beating returns in the offing. And the main reason and the main driver of this is much lower inflation. In this graphic, you can see the CPI in South Africa from January last year, where we came out of a period of fairly high inflation in terms of the headline number, about 7% in terms of the red line on screen. Stripping out food and transport, food was much higher as we were effectively under the impact of higher interest rates and also a much weaker exchange rate as well. So as a result of the fairly high food inflation moderating, we have seen a structurally lower CPI number, the most recent data point about 4.4%, which is fairly in line with the midpoint range that the Reserve Bank wants to have. They've guided to 3 to 6% at the midpoint of 4.5%. So 4.4 is right in the middle of that. And we have seen a commensurate cut in interest rates in South Africa. What we find quite perplexing is that despite inflation being at the midpoint and being in line with the Reserve Bank, the Sukuk market and the conventional bond market is assuming much higher longer term inflation. This is captured in the next slide, where you can see firstly what we have in this graphic is a 20-year break-even inflation. This is effectively what 20-year bonds and Sukuks are implying in terms of longer-term inflation, which on average is around 7.5%. Bearing in mind we're seeing inflation at 4.4%, and the Reserve Bank is targeting 4.5% and potentially lower than that. And then in contrast, the 5-year numbers, again a similar calculation, break-even inflation at about 5.5%. So clearly either inflation will have to increase substantially over the next 5 to 10 years, or those bonds and Sukuks are substantially mispriced. We believe that it is the latter, and if one looks at actual Sukuk yields on offer in the market currently, on 10 and 12-year Sukuk, we can get double-digit 10% plus in terms of those Sukuk rates, which again in the context of a 4.5% inflation number is substantially above inflation and fairly attractive. So our strategy in terms of the Sukuk portfolio has been to go long. So we've gone long duration. We've adopted quite a few of the government Sukuk in terms of the longer end of the term, and that has resulted in a fairly higher increase in terms of the yield that we currently have in the Sukuk portfolio as well. In the short term, we see downside risk to yields as the SARB, or the Reserve Bank, continues to cut rates. and that makes it less attractive compared to the longer term yields as well. And this is encapsulated in terms of our yield curve. So we've got a proprietary Sukuk yield curve. Firstly, this is a snapshot of 5 years ago. What we have in the slide, the light blue band, is our fair value range, where we think conventional bonds and Sukuk should be trading at. We also overlaid the actual fair value curve in terms of our conventional bond market curve, and then overlaying that is the actual Sukuk yield curve that was prevalent in August 2019. So 5 years ago, and you can see it was above that level. So there was opportunity to get exposure to those Sukuks in 2019, which is what we did when we launched our income fund, our high yield fund. Contrast that to the picture today. We've actually seen a shift upwards in terms of the actual Sukuk. So in this slide, we highlight via those triangles the actual Sukuks that we have in the portfolio. And you can see the substantially higher yields that we currently get. Just to pick a few, the RS 2036, for example, that's a 13-year Sukuk from current levels, gave you a yield of close to 11%. A more appropriate fair value for that Sukuk should be about 9%. So as these yields start to go back to normality, there's massive opportunity for capital appreciation. Going from 11% to 9% results in more than 20% capital appreciation. And already this year we've seen, as yields have moved lower, stronger capital appreciation in the Sukuk portfolio in our Islamic High Yield Fund, but also in our Islamic Balance Fund as well. So we're quite excited. We think that these Sukuks are giving you quite high inflation-beating returns, and we are positioned effectively to benefit from that on behalf of our investors as well. As you can see the next slide, which just highlights some of the actual Sukuks. These various bubbles represent the actual size of Sukuk that we have exposure to. The duration in days, you can see up to about 3 to 4 years, giving you an average yield of about just under 10.5% in terms of our Sukuk market as well. And we've clearly avoided some of the shorter term Sukuks, and also there's fairly little corporate Sukuks on offer, but we prefer the government Sukuk. It does have security of tenure, it does have the safety of a government guarantee compared to corporate credit as well. So in conclusion, why Camissa Islamic Funds? It has been a challenging year, especially the first half of the year. We have seen performance coming back quite strongly over the last couple of months. And that's testimony to our performance signature. We are a true high conviction active manager. And as a result, in the short term, our portfolios will look very different to competitors. It might result in shorter term underperformance, but in the medium to long term, we have seen performance correcting and rebounding quite strongly. And as a result, our longer term performance signature is fairly intact and peer leading as well. It's the same investment team that have been delivering our equity alpha returns performance over the last 20 years, 15.1% returns over 20 years. Same team, same philosophy, same process as well, which is what we believe will stand us in good stead to navigate through this period of shorter term underperformance as well. We are very differently positioned, and I've spent quite a bit of time in this presentation highlighting our very different opportunities that we see in our portfolios, both locally and globally, and also in the Sukuk market. And ultimately, we believe that these opportunities does give us high expectations for a recovery and rebound in terms of performance that we've seen. Already, we've started to see that coming through in terms of the portfolios. But I think in the medium to long term, given our very different positioning compared to competitors, we also blend very well with larger managers, both in the Sharia space and also in the conventional space as well, to give you a fairly different outcome in terms of portfolio positioning. And ultimately, we believe that our domestic, our global, and our yield assets has the potential for material outperformance as these markets normalize and as our investment thesis start to play out. We thank you for your time, and we look forward to engaging with you soon. Thank you.